The Fed has finally decided to pause interest rates.
A decision on a pause was not made today.
Here's the thing. The Fed hiked interest rates today by 0.25%, but signaled to the market that a potential pause is on the way, which is essentially the only option that the Fed actually had, to hike rates by 25 basis points, but also signal a willingness to let that be the ceiling. And that's essentially what the Fed did, both in the announcement as well as multiple times in the press conference following the announcement. Now, as many of you know, this was the 10th interest rate hike in just over a year, which took the Fed funds rate from 0% about a year ago to a target rate of 5 to 5.25%, which was a unanimous vote. But here's the key. The Fed left the door open for this to be their last rate hike by essentially dropping certain verbiage in their announcement. Now, I'm not going to sit here and read everything that changed. I'll throw it up here on the screen so that you can see it. And you see a lot of red lines, a lot of strike throughs in there. And that's essentially what the Fed changed in the announcement. But essentially, they dropped verbiage about policy being sufficiently restrictive, in addition to dropping the phrase in determining the extent of future increases. And the bottom line is they're prepared to let this be the ceiling as long as the data coming out doesn't demand otherwise, which is exactly what we're going to talk about in today's video. We're going to talk about employment, we're going to talk about prices, we're going to talk about interest rates, and we're going to talk about how that might affect you as a buyer or seller in today's market. But before we do that, I want to take a minute and ask a favor. If you find any value in the videos that I create, do me a favor and hit that subscribe button, as it helps the YouTube algorithm show it to more people like you. And also feel free to subscribe to the channel to stay updated on everything real estate related. Now, as many of you know, when Powell does a speech like this, the remarks he gives are already prepared ahead of time, which have more or less been generally dismissive of bank risk, with the focus on the ongoing fight against inflation, because we know the Fed's goal is to get inflation down to their 2% target. But at the same time, you have ex-Fed President Kaplan saying that the bank pain is just getting started, which is one of the key elements to why we're likely to see a recession later this year, is all of the credit tightening. In fact, Powell reminded us in the press conference that Fed economists are still forecasting a mild recession later this year. So with that said, when I say mild recession, what do you think as a viewer? You're seeing credit tightening, you're seeing bank failures, you're seeing house prices continue to go up, you're seeing companies doing layoffs. Do you think we're actually going to see a mild recession, or do you think we're going to see something larger? I'd love to know your thoughts. Do me a favor and leave them in the comments below, and let me know why you think that. Now, here's something really important to know, is that the Fed funds rate will essentially be higher than CPI over the next couple of months, unless the Fed starts cutting rates, which I don't think is likely to happen. So if the Fed funds rate stays at 5.25%, then that's going to be significantly higher than CPI, as we're likely to see CPI fall closer to 3% by the end of July. Now, if you're watching this going, Jeb, how do you see inflation falling that much that quick? Well, it's because of how they calculate the CPI numbers. Remember, they take all of the monthly CPI numbers and add them up over the course of 12 months. As you can see from this chart here, April CPI is 0.4%, May CPI is sitting at 0.9%, and June CPI is sitting near 1.2%. And that in itself totals 2.5%, which is being factored into the current CPI numbers. But here's the thing. Later this week on Wednesday, we're going to get updated CPI numbers, which is likely to show a big drop year over year with regards to the April CPI. In addition to that, we're expecting shelter and rent inflation data to continue to come down and start to reflect more normal numbers, which means that we're going to be replacing that 2.5% with numbers ranging somewhere between 0.3 and 0.9%, which means there's a high likelihood that we're going to see a big drop in inflation over the next 3 months. So why has the Fed continued to push so hard, continue to raise the Fed funds rate when we're starting to see a slowing economy? Well, there's really two things. One, inflation has remained high, even though many of us out there looking at rent and shelter inflation data see that there's a lag in how that data is being reported. The Fed isn't really looking at the lag. They're looking at the actual numbers. And because those inflation numbers are reporting high, they're still seeing inflation much higher than they want to see. At the same time, they still see really strong employment, even with all of the credit tightening that they've done and the interest rate hikes and all of of that craziness, which essentially has given them the authority to continue to do what they've been doing. But here's the thing, we're starting to get some mixed data when it comes to jobs. As we just saw ADP data surprise with the biggest private payrolls gain since July of last year, which essentially showed that private payrolls rose by 296,000. Now, for many of you out there watching, you're like, what does that actually mean? Well, the estimate was for 133,000. So we had way more people employed than they had expected. But here's the thing, when the market got that data, they didn't react. Nothing really happened within the bond market. We didn't see a huge spike in the 10-year, which is something we would normally see when you got disappointing data like this. And part of the reason that we didn't see anything crazy is because a lot of people out there believe that ADP maybe has it wrong, that they've manipulated the data in some way that's not showing the correct numbers. Therefore, the market took it in stride. At the same time, we're seeing the number of layoffs rise in March. And on top of that, we're even seeing companies out there that laid off employees 6 months ago, companies like Meta, who is still laying off employees. In fact, they just chopped 1,500 jobs in the Bay Area. So even though we have ADP data showing that private payrolls are going up, on the flip side, we have data showing that layoffs are actually going up, in addition to seeing JOLTS data, which is job openings data, falling more than expected in March to the lowest level that we've seen in nearly 2 years, with job vacancies totaling 9.59 million, which is down from 9.97 million in February. So we're seeing the number of jobs available out there also shrink at a time when we're seeing more and more layoffs happening, in addition to bank failures out there. So more or less what we're seeing is that the Fed's hike on interest rates is likely starting to take hold as we see more and more credit tightening across the board. Now, here's the crazy thing. With all of that stuff that we just talked about, interest rates kind of bouncing all over the place, employment starting to get a little bit worse, we're seeing home prices on the rise as the spring market proves to be more competitive than previously expected. And that's because home buyers are eager to buy, but sellers, they're scarce, which is essentially creating this gridlock, if you will, with low inventory, which, as we've talked about several times, has prevented prices from falling even further, which is exactly why we're seeing headlines like this, that the New Jersey housing market slips right back into a pandemic housing boom as everyone is fighting over crumbs. Now, I know a lot of people watching this video going, Jeb, I know we have low supply out there, but what about new construction? What about all these homes coming to the market? Well, we know at the moment that nearly 31% of the available inventory out there is actually new construction, which is exactly why we saw a jump of 9.6% in new home sales last month, as tight supply fuels demand for newly constructed homes. In addition to that, there's a belief out there that the building boom has prolonged the market pain. Because of all of this building happening out there, it's created jobs within that sector, which is one of the reasons that we haven't seen employment numbers drop so significantly, because of the construction market and the number of workers needed to build these homes. But here's the thing. Earlier, you heard me say about mixed data out there. We're getting some good data, we're getting some positive data. Or earlier, you heard me talk about job layoffs, you heard me talk about job growth slowing. Well, if you look at this chart here, it looks like we're starting to see a spike in construction layoffs as well. So if we see more and more construction layoffs, which has been a huge piece to the employment number to begin with, then we're likely to see those unemployment numbers rise a little bit more significantly over the next couple of months. But here's the thing, supply and demand drives market. So if you're in a market that has a lot of new construction, homes that are currently under construction that haven't been built, that are likely to be finished in the latter part of this year, there's a number out there, over 700,000 homes that are supposed to be completed later this year. So if you're in a market that has a lot of new construction, then there's a chance that you might see a further slowdown in housing. But if you're in a market here like I am in Southern California, where we have very little new construction, then that new construction boom, if you will, isn't likely to affect prices the same way. At the time I'm filming this video, we have 422,000 homes that are available nationwide on the market, which is significantly below the historical average, which is why we're still seeing home prices go up in many areas while we're still seeing multiple offers on properties. And exactly why we're not seeing the crash that everybody was hoping for. It's because we still have more demand than we do supply. And on top of that, many home buyers out there have already gotten a little bit more accustomed to the higher rates. In addition to that low supply, which is why we've seen 93 of the nation's 100 largest housing markets actually go up month over month, as you can see from this chart here. Whereas only just 5 months ago, we were seeing a month over month decline in 92 out of 100 markets out there. In fact, the biggest jump in March was Columbus, Ohio, who saw just over a 1% gain. Whereas on the other hand, Austin saw the biggest decline at 0.72%. So not all markets are created equal. And that's exactly why you have to find a local professional in your market that you trust, that understands the data, understands what's happening, and can ultimately guide you through the process. Now, I want to be really clear with you. I don't think that all of the information that I'm providing, the Fed potentially pausing, the employment numbers changing, all of this means that the market is going to start doing something crazy. It's going to start going crazy again. House prices are going to go nuts because of low inventory. I don't believe that at all. In fact, I think the economy is likely to get much worse as the unemployment numbers start to go up, as we start to head into a recession. But at the same time, I don't believe that's going to cause a housing market crash either, because of the things that we've talked about in the past. Because many sellers out there have been locked into super low interest rates, they're just going to stay put in their homes and continue to pay on those low rates. At the same time, I do believe interest rates are likely to move lower as they follow inflation. So we're going to see interest rates move lower, which is going to create some more buyer demand in the market. And on top of that, I know we're going to get some people that own homes that get laid off, that lose their jobs. Some of those people are going to need to sell their homes. Many of those people have equity in their property. It's not going to be a forced sale like a foreclosure or a short sale. It's going to be a standard sell. And on top of that, some of those people laid off will get another job and continue making their payments. So I don't think you're going to see foreclosures rise, but I do believe the lack of supply in the market is a problem. It has created this gridlock that we've talked about. And quite frankly, I don't believe there's a solution to it in the short term, which means that you're likely to see housing remain stable. But if you want my additional thoughts on where interest rates are long term, do me a favor and check out this video here.